In this video, I will be showing you the only strategy you need to get a 99% win rate in the market. This strategy works for both reversals and for continuation. Anytime you see this pattern in the market, that trade is a short trade. You can risk your high chance on that trade and that trade will play out. This strategy is called the market structure shift. What is the market structure shift? The market structure shift can be defined as this change in the state of price delivery. Let me break it down for you now. It just simply means when the market is, let me say in a bullish trend, the market is retracing. When this pattern shows, that means that retracement has ended and the market wants to start going back to the extension, wants to start buying back. Or in a bearish trend, market is buying, which is retracing, and this pattern forms. That means the market have finished that retracement and want to start selling massively. That's what this pattern means. So how do you identify this pattern in the market? It is very simple. If you are in a bearish trend, because as I said earlier in our previous video of Fibonacci, you have to know the trend of the market. The trend is very important. When you are looking for a strategy, the strategy must be in flow with that trend, because if the market is against that trend, that means that strategy will be useless. So you have to flow with the trend. So let me say in a bearish trend now, this is a bearish market structure shift. In a bearish trend, market is maybe retracing to the upside, retracement is occurring, and then for you to identify this pattern now, what you have to do is wait for the market to take out a high, an old high, then create this low that took out this high. Immediately the market took out that high, you have to immediately displace lower, and take out the low that were responsible for taking out this particular high. So there must be displacement lower. So that word displacement, please, you can write that in capital letter or upper class letter. That word is very important. Displacement. There must be a quick displacement of price to the downside. That means the volume has changed. The market wants to start selling. The sell pressure, or whatever you call it, has entered the market. Now when the displacement has formed, there has to be a fair value gap in between the displacement high and displacement low. As you can see, the high responsible for taking out this particular place is called the displacement high. This is displacement high, but this is the displacement low. So inside this range, there has to be a fair value gap inside that range. So let's head over to the chart and look and check whether it is true or not. Let's go. Now we are on a live chart. As you can see on this chart, the market is going to the upside. You can see the candles are going up. Market is going up and going up and going up. Now immediately this pattern form. Let's look at the pattern here. Look at it here. This is the pattern. We have the displacement high. Market took out this particular high here. You can see this high here. Took out this high. So let's mark that out. Took out this high. Took out this high. Then this was the low response for taking another high, right? To the low. Then we have the displacement high here. This is the last high market created. So now as you can see, there was a quick displacement to the downside after market took out this particular high. The immediately shifted lower to the downside. Note, look at the body, look at the candle closes. Look how the candle closes. It was very thick. So I will show you guys the wrong one and the right one. So this is the right one. After this one, we'll go back to the wrong market structure that you should avoid by all means. Then you can see the market's created these fair value gaps. Created these fair value gaps here. One. Created this one too. The fair value gap here. Two. So as LVG fair value gap. When trading the market structure shift, always use the second fair value gap, because that is where price is likely to head to first before moving to the downside. That's where price is likely to retrace to, because most times it does not retrace to the first fair value gap that forms. As you can see in this example, it did not come out to this particular zone here, but it reacted from the second, which is the second one, and started moving to the downside. So when you are on this trade, just look for low risk to reward. Don't go for high risk to reward 1 to 10. You want to be profitable, go for low risk to reward. Your highest should be 1 to 3. So we'll be using 1 to 3 in this example. So you go for your short, place the order here. Then your stop loss will be at the displacement high. What's the meaning of stop loss? Meaning of stop loss means a place that invalidates your trading strategy. It's not a place that you are willing to lose money. This is a place that invalidates your strategy and invalidates your setup. That place, if market hit that particular place, that means the setup here has failed. So drag that down to 1:3. I should think we're gonna expand to the side. You can see clear. The market hit that zone clear. The market smashed the TP clear, like it was very clear. You can see we have market short sheet formed here. So the market short sheet formed. Immediately for market was buying since, so immediately market short sheet formed. Started coming to the downside and headed straight to our tip. You can see the market was even going to downside. You can see this straight like giving us a level of 1:6. But never go for 1:6 or 1:5. Always go for 1:3 because that is very attainable. If you are going for high risk to reward, there's a high chance of that market reversing. But you can go for high risk to reward on swing trading. But for day trading, it's advisable to go for low risk to reward, which your highest should be 1:3. You can go for 1:2, 1:1. But on day trading, never go for 1:5. I've done that before. I know what he did to my trading account. So here we have another example of the market short shift again. As you can see, we have the liquidity grab here, which is that higher market took out there. Let me put as $1. Then we have the displacement high, which is this particular place. This is the high. Then we have the displacement low, which is here. See, displacement low. Market created this high, then came to the downside, then took out the high. So the low that was responsible for taking out this high, which is displacement low, market have to immediately shift lower to the downside. As the market, the candles was very good, they closed very good. Then you can see the market retraced back to the first favorable leg up. So, but it's advisable to use the second one. So we use the second one here. Favorable leg up here. Go for 1:3. Stop loss will be at the displacement high. See, nicely hit. Can see, nice market. It was very nice. That displacement high was formed, displacement was formed. The fair value gap, enter for the fair value gap. Then, so you have to know your trend. If you don't know your trend, the market short shift will not work. So you have to know your trend first. Know your trend. Now, this is a clear example of a market short shift that you should avoid by all means. You can see here, you have a displacement low here. Market took that place to displacement, yes. But was there a displacement high? No. For the market to form correctly, you have to take out an old high, then displace to the downside. But you can see market don't take out any high, but you displace and took out that low. So let's see the result of it. So you have fair value gap here, right? Fair value gap here. And so we'll see whether the thing actually worked or not. As you can see, it headed straight to the upside. No reaction at all, self. So this is a clear example of a market short shift you should avoid. And here's another example again. You can see here, market took out this low with displacement, but did you take out that high? You don't take out the high. But he formed the fair value gap for us, which is here. As you can see, the result too, market was still going up. So these are clear examples of a market short shift you should avoid. But as you can see in this example, the market short shift was very clear. There was a displacement high. The market took out the displacement, took out this particular high, then formed the displacement high for us, then immediately took out the displacement low. And as you can see in the results, which stated earlier before, it headed straight to the downside. So this is the right market structure shift you should trade, and that other one is the wrong one you should avoid by all means. So if you want to, for the bullish market, you have to just reverse it to just turn it upside down. Understand? Just reverse it. Not the same thing, but reverse it for the bullish side. I don't want to make this video a long one. I don't make it a long one. So see you guys on the next video. In the next video, we're talking about risk management and why it is very important in trading.